We often hear people talking about debt, but is there a point where it stops being helpful and actually starts hurting the economy? That's exactly what we're going to explore today. When does debt stop creating growth? Okay, so first things first, let's be clear. Debt itself isn't the bad guy. When it's used productively, it's an incredibly powerful tool. I mean, think about a business taking out a loan to build a new factory, or a government borrowing to build a bridge. That's debt fueling real progress. It can be a real engine for economic expansion. But, and this is the crucial part, that positive relationship doesn't always last. Over time, something interesting tends to happen. You see a lot of mature economies piling on more and more debt, but they're just not getting that same bang for their buck in terms of growth. It's like the power of that debt is starting to fade.
So, what gives? Why does this happen? Well, to really get to the bottom of it, we have to look at how the role of debt changes as an economy grows up. Let's dive in.
All right, first, let's look at the good times. We'll start with how debt acts as a growth engine. How borrowing can really fuel productive expansion when everything's working right. This is basically the ideal scenario, right? It's a simple, virtuous cycle. It starts with borrowing, then that money gets invested in something productive, say a new machine that makes things faster. And because of that investment, output goes up, income goes up, and paying back that loan is no problem at all. When it works like this, everybody wins. But of course, that perfect cycle doesn't always last forever. So what happens when it starts to, well, break down? That brings us to our next point, the idea of diminishing returns. We're going to look at why each new dollar of debt can start to become less and less effective. And here's a really simple way to think about why. In a young, developing economy, it's like there's all this low-hanging fruit, tons of great high-return projects to invest in. But as an economy matures, the most obvious super productive investments have often already been made. So any new borrowing might go into projects that are, well, less productive. And that means the economic kickback you get from each new dollar of debt just isn't as big. And this leads us to a really critical tipping point. We call it the servicing burden. This is basically the stage where the sheer weight of all the old debt starts to grow faster than the income being created. And that, as you can imagine, really starts to drag the whole economy down. This chart shows it perfectly. Look, in a healthy situation, income and debt kind of grow in lockstep. But see that gap? When the debt line starts pulling away from the income line, that's a huge red flag. It's a clear sign that the new debt just isn't creating enough new income to pay for itself. So what does that gap actually mean in the real world? Well, it all comes down to something called debt servicing. Think of it as the money you have to set aside just to pay the interest and principal on all the loans you've already taken out. It's the ongoing cost of carrying your past borrowing. And here's the kicker. Every single dollar that's spent just servicing old debt is a dollar that can't be used for something new and productive. It can't be invested in the future. So you end up in this situation where resources are being used to pay for the past instead of building for the future, and that's a major headwind for growth. Okay, to really get this, we need to talk about two different kinds of debt because, not all debt is created equal. Let's break down the critical difference between productive and speculative debt. So on one hand, you have productive debt. This is the good stuff. It's borrowing to build a new factory, invent a new technology, anything that actually increases our ability to produce things and supports long-term growth. But on the other hand, you have speculative debt. This is more about borrowing to buy things that already exist, like real estate or stocks, hoping their price will go up. While it might make asset prices boom, it doesn't really add much to the economy's overall productive power. So what happens when an economy gets weighed down by all this unproductive debt? Let's look at the consequences when that growth inevitably starts to slow down. And this quote really nails the central idea. The problem isn't the existence of debt itself. The problem is when the new debt you're taking on doesn't generate enough new income to cover its own costs. When you cross that line, real sustainable growth becomes, well, pretty much impossible. And the fallout from this kind of imbalance can be pretty serious. First, economic expansion just slows to a crawl. The whole financial system becomes a lot more fragile, more brittle. This means that any kind of shock, like a sudden change in interest rates, can have a much bigger, more dangerous impact, which raises the risk of a real crisis. All right, we've gone through quite a bit, so let's just take a moment and summarize the key takeaways on this whole debt life cycle. To put it all together, Debt starts out as a great tool for growth, especially when it's funding smart investments. But as an economy matures, the effectiveness of new debt can start to decline. Eventually, you can hit a point where debt is growing way faster than income. And when that happens, the rising cost of just servicing that debt starts to crowd out new investment, and the whole engine of growth begins to spud. So at the end of the day, the key isn't just the amount of debt, but its purpose. The big question every economy has to ask itself is this: is our debt building the future, or is it just a drag from the past? The answer to that question really does shape what comes next.